Hello and good morning. Oh, sorry, technical difficulties on my end. Hello and good morning. It is December 12th, 2023, and this is the AgYield War Room. I am everyone's favorite backup host, Jack Coakley, filling in for Dan yet again today. Thanks again for being here. Again, always streaming from YouTube, Facebook, and X. And if you have any questions during today's show, just go ahead and shoot them into the chat. We are always available to answer questions at info@agyield.com. From there, let's head over to John with the overnight numbers.
Yeah, thanks, Jack. Good morning, everyone. March corn was up to 483.5. Jan beans were down 1 1.25 at 13.34 3/4. March wheat was up 2.5 at 6.12 last. And I would just also mention that some of the energy markets are getting hit a little bit today, so keep an eye on that.
Thanks, John. Good moment to mention that if you're not subscribed to the YouTube channel yet, please go ahead and do so and get live updates on everything we're doing over here at the War Room and AgYield. From there, I'm going to kick it over to Ben, who had some thoughts on beans. Ben, take it from here.
Good morning, everyone. The bean market seems to have a lot of consternation between people who are bullish and bearish based on weather in South America. And when I step back and take a look at the bean chart, I see a very range-bound trade. Going back to July, we've spent just a handful of days above 14, just a handful of days below 13. And the moving averages sort of reflect that, with the 200-day at 13.20, the 50-day at 13.41, and the 100-day at 13.51. We're through those. We were above the 100-day overnight. Hit the 2025 and back below there. So this just kind of becomes a middle of the range trade that can be very choppy. And if you're looking at it from a hedger's perspective, getting a plan in place, should we move back to the top side of the range, is probably a good idea on both old crop and new crop if you're looking for coverage. If they create those sort of opportunities, I think thinking forward and being proactive to be in place makes a lot of sense. We didn't spend a lot of time up there, so don't wait for it and react. If you have some ideas in mind, talk to your advisor, go through a plan, have something in place. These holiday markets can be exceptionally thin. We did see a flash sale overnight of beans, but they're gonna, this is ultimately a weather market, and whether or not we break out of the range in either direction remains to be determined. But I can tell you that people that have sold the bottom of the range and bought the top are having a very frustrating experience. So, not to be emotional about it, but if there's strength, use it as part of your plan, and be cognizant of the fact that soybeans can change dramatically if the weather shifts down there in any way. Options are very cheap in order to be able to protect that if you make sales, or look for some other type of protection on the downside. So to me, it's a range-bound trade. It's a wild chop within a dollar range. And I think that if you step back and look at it from that perspective, you want to be the person from a hedger who's rewarding it on the top end. So
yeah, and Ben, just to kind of add to that a little bit, and I'm not as big of a technician as you are. I know enough to be dangerous, but just looking at some of these charts, one thing that I've noticed over the years, like if you've traded these prices a lot of times now, between 13 and I'll call it 14. Yep. Looking at counts here since last June, 7, 8 times. So a lot of people that have wanted to trade in those price levels have traded them, right? So if you start busting out of those ranges, one or the other, it tends to be a violent move. Sometimes it can be kind of a head fake just for a bit, but a lot of times, if you look at natural gas, we can maybe look at that tomorrow, but it's been in a range for 7, 8 months and then just collapsed once it got through the bottom end of it. And it's been a bloodbath, this whole week. So at that point, like, it can move really fast once it gets outside of those ranges because they've been traded so many times. So to your point, like, it's really important to have those targets, because like you see last summer, you have an idea, and if you just kind of wait for it to see how it acts up there, it can do it in a week and then be back down to where it started. So
yeah, well, and I think that that's a great point. We've seen this, and really any market that trades, when it trades through a range multiple times, it depletes the book of resting orders. And as it progresses through that, it reduces those orders and the need for people to either buy it at the low or sell it at the high end of the range. And consequently, you get these wild gyrations within there. And then once it goes, it's either I missed the boat or I was stuck in the wrong position. And it certainly behooves looking at your strategy in advance, as opposed to all of a sudden you wake up one day and soybeans are trading $13.95. And you really wanted to do some of that. And then the next time you go back, or you get called by an advisor, and the next time you get back to them, you're back down to $13.50. So I think being proactive in a market like this is extremely important if there's some things that you need or want to do.
I agree.
Certainly. Any other replies or comments on top of that discussion?
I think that, the soybean market was slightly emboldened after the Commitment of Traders report. They had shaken quite a few longs out, and it potentially emboldened people to run it back up again with, what was perceived as disappointing weather in South America. And, they're soybeans. They could be trading $13.10 today, and they could be trading $13.85 or $13.90. So it's a thin holiday market. Don't wait. If there's something or an error, if you're frustrated that you missed last time, or a strategy that you want to put in place, I would get it in and get it working, because that could be a really good Christmas gift for you.
Yeah, and I'll add to that too, just on the entire bean discussion. A lot of things, we keep getting a big move on beans, and then we're seeing the headline after the fact, right? Like maybe it's dryness in Brazil. There's always going to be an explanation that I think strategists will find for the move. But there has been a very clear inverse correlation with wheat and beans that is clearly getting funds to move in and out of that as a pair from our perspective. And we saw that in the Commitment of Traders report. We said this yesterday. Since the first notice day, we've been inversely correlated about 60%, which is very high for those two products. So, there could be some very weird reasons for the bean liquidation to begin with. Like Chinese buying of wheat caused them to bail out on their wheat shorts, and their bean longs as part of the pair. That's a theory. It's not necessarily written in stone that that's how it's going, but it certainly feels that way. So that's one thing to watch. The other thing is we continue, and I'm going to switch gears here a little bit. We're getting a lot of questions about hedging DEES 24 corn right now. That's going to be an individual decision with our customer base and based on their margins, of course. But I just think food for thought on what our opinion, or my opinion at least, would be about DEES 24 corn is how it relates to what the two things I think could impact it the most is what's the size of carry in from this year's corn, which we're still going to determine in the Jan report, and then how are new crop beans reacting on a ratio to that. So we've been hitting this magical 60% of full carry number here in the lead month contracts. Septa DEES did it, DEES to March, DEES to July. Now all of a sudden we're at 30% of full carry March to DEES, right? I still think that there's a question to be played out of what is that old crop tightness once you get back into the next round of farmer selling from old crop to new crop corn. And I think that if it's not on your radar, that's something to start watching. Is March DEES is only a 27-cent carry right now. That's only 30% of full carry. And I think the market's still kind of realizing we're in a new type of a carry situation in these interest rates with the new CME warehouse receipt costs. So, they're not new, but first time we've actually got to test them out since 2019. So something to watch.
Yeah, Dustin, I think to that point, it's kind of that weird dynamic where, in my opinion, DEES, we haven't been in this kind of a carry market for a handful of years now. And so DEES 24, you start getting up to that 520, those higher just flat price levels, you attract some selling. And the short is generally the fund shorts in the the March or the nearby, right? So they can get some of those kind of spread dislocations for a bit. But I think that's why, you could see where DEES 24 at some point has trouble on any big rally, like if South America does run into more problems, just because you start looking at, 530, 540, 550 type flat price number in D's 24, I think it's going to be really attractive to a lot of people, especially looking at what potential crops coming from South America. You start also, we're going to be shifting back to after the January report. Do we need all the acres? South America doesn't have a problem. We're going to be, my fear is scared that we have too many acres of both. And the upper mid lower fives are going to look kind of high price for D's 24 corn potentially.
Right. Yeah, that's a good point for sure. And the question though is it, do we have too many acres because we have too much carry in though? Is that also part of the problem?
Yeah, absolutely.
That's the question of what are spreads capable of, if that's the case, and does it take time for the market to actually price that in? Because I don't think you do have a very easy, free producer seller right now at these sub $5 futures prices in the U.S. until the cash flow is needed.
Mm-hmm.
I think that's part of the reason why the spreads might not be as wide as they could be in this environment.
Oh, there's no doubt. Yeah, my point of it is sometimes when you get to a flat price, it doesn't matter. Like ultimately, I think that could be the case, but that could be the case at, 430 corn. So if you bear spread corn and make 15 cents, it could be on $1 flat price break.
Right.
So I think it's cognizant to look at like both the flat price and the spread action. Because we've seen this happen before where, selling the back end even at big inverses has made sense because you're onto a different crop year. It's got a different fundamental balance sheet. I'm not saying that. I think 23 is probably going to feel heavy supply wise for a while unless we start changing something. China buying a bunch of U.S. corn or something in the export market. It doesn't seem like that's on the horizon right now.
Right. We did the surprise for the wheat market, obviously, which I think the wheat market was not prepared for. So I'd love to see it come out of a surprise for corn, all of a sudden to see a corn export market. I just don't believe that it's coming either. So
I think the wheat one is interesting. And Ben, you're, kind of out that way, but spring wheat country or soft red wheat country. But I think, they had really big production out east. I think the commercials loaded up on storage because there were such good carrying charges to be made by storing wheat. So I think they got their hands on a lot of soft red wheat. And then we had a record bean and corn crops out there also. So they just ran out of commercial storage. And I think it incentivized them to probably price some wheat, get some out of there, and fill up bins with, corn, maybe diversify a little bit. I don't know what you think, but that's what it feels like to me.
That's absolutely what happened. In the last couple of weeks, a fair amount of wheat has moved out of storage in order to make way for corn. I'm sure that it costs whoever bought it a carry plus out to July on wheat, and the commercial is very savvy at using their space. It's how they make money, and they took their carries in advance, I'm sure, and looking to now profit on corn. And with the region being heavy corn consumer, they're buying corn at 50, 60 under, looking at 35 to 40 cents of carry moving forward. And we saw these July move out to 49, and probably a basis appreciation. I mean, pick your number, but somewhere in the neighborhood of maybe 40 to 60 cents. So they made a very savvy financial decision, and that's what happened. They needed to make space for corn for their customers. I think to both of your points as well, that we look at the seasonal aspect of corn, and lowering your expectations on what can happen with all things remaining the same is pretty important, because you mentioned it as carry, and well, I'm looking at it as a lot of unpriced corn, right? People haven't been aggressive on 23 crop to the degree that they should. We've seen that with the rolls and the basis contracts. Why would they go out and be heavily sold in 24 with that happening? So I think that there's a wall of corn above the market, and I'm going to put my tinfoil hat on for a second. You can always over-informate, but I'm somewhat of a simpleton when it comes to grain markets. The low in March was 370. We know that most of the contracts were rolled probably between 18 and 20 and a half. Commercials had people getting out. And our rally in corn was right at 23 and a half cents. So is that the market telling us that we're not going to reward basis contracts, right? We're not going to reward this moving forward. Now, if we start doing a bunch of business to China, that can change. But I did find it interesting that our rally was kind of halted to about where we rolled it, in spite of a really big rally in wheat, which normally can kind of drag things higher. So,
yeah, I'm gonna add real quick, and then the markets are open. So, corn's up 2 3/4 at 484, beans down 4.5 at 1331, wheat's up 5.5 at 615. But just real quick, I know we kind of running out of time here, but the interesting thing about that, we've talked a lot about this in our letter when it comes to spreads, is the supply, and the supply is in the east, the big supply. The river system, our delivery system's based on the river system in the east. The smaller crops and the export demand with the low river is actually coming off the PNW. So we're going to see these, in my opinion, these stronger basis as more grain is flowing to the Pacific Northwest than down to the Gulf. So this could be an interesting winter. Where really anything based off the river system just continues to struggle, outside of like interior processors, things of that nature. But, so much of our delivery system is off the Mississippi River and Illinois River, Ohio River system. And, I think they're still loading at maybe 75% capacity on barges, right? So the cost is super high. And then you've got to compete with, low Panama water levels, right? So there's just a lot of transportation issues on grain to, from the Gulf, into Asia, especially. So I think that's going to be an interesting dynamic too, as you're pulling a lot more bushels by rail to the PNW versus down the river system. So,
excellent. Any parting shots, guys? All right. Well, thanks again for tuning in, everyone. Like I said, subscribe to the YouTube channel and receive updates on all things AgYield and the War Room. And have a great day. We'll see you tomorrow.
Thank you.
Thanks, Jack.